Hey everybody, it's Mike DeShazer here at Proof in Seoul, South Korea, and today we're going to talk about yield farming and effective yield farming diversification strategies that can optimize potential returns. So first, we're going to dig into what yield farming is. For example, we're going to look at platforms like Pickle, Farm, Harvest.Finance, etc. And we're going to take a look at how they differ, and we're going to look at how the returns are generated, either through liquidity mining, which is placing LP tokens on automated market maker platforms like Uniswap or SushiSwap and collecting fees into a pool, flash loan revenues, which are paid out when people borrow thousands to millions of dollars to perform trades. There's small fees that are charged on top of that, and then for the people who provide that, a little bit of the funds are provided to them. LP token staking in general, so taking a very volatile token, staking it to create price stability within an ecosystem, and then that ecosystem rewarding you with their own token. Those can be very volatile, but we'll take a look at those, as well as options fees like through Hedgic and other platforms, and a variety of decentralized fee-based structures that provide funds into pools that are then used by these yield farming platforms either individually or aggregated with rebalancing strategies on top of them to provide maximum yields. And we've seen yields in the yield farming from anywhere from 5% APR and APY all the way up to 500% APY. So we'll talk about the difference between the APR and the APY, as well as kind of a little bit of the compounding strategies that might be leveraged, taken into consideration gas fees, etc., for the sum of money that you might start with as your principal to begin compounding or earning. We'll look at the cash flow aspect of this and how that affects the tokenomics of various tokens, and we'll look at various strategies that we could potentially implement to optimize any given return-based initiative. So let's sit down and take a look at some of the yield farms and yield farming strategies. All right, in this video, we're going to talk about how to turn this simple account, which has 0.025 Ether in it, into a yield farming account. If you're already familiar with yield farming and understand how that works, you'll probably want to skip this portion of the video and go about midway into the video where we talk about optimizing your yield farming strategies and creating Node.js apps that can interact with smart contracts that can help you optimize your yields. All right, but if you're new to yield farming, this part will be probably really useful for you just to understand the basics of how the yields work and how to actually begin to yield farm starting with a small amount of Ether, which can be scaled up obviously into a much larger amount. We're going to start by farming on a platform called Harvest.Finance, and then we'll move on to a platform called Pickle. Both of these platforms have hundreds of millions of dollars locked inside of them that are earning yields. For example, this profit-sharing farm called Farm is earning 229% APY, while this one is earning 225% APY. So the APY is the compounded annual return. If not compounded, it is 119% annually. So this one auto compounds, meaning all of your proceeds that you earn are automatically reinvested, which show this higher APY yield, versus this one where if you don't continually add in new tokens, you will not get the APY. You'll just get the APR. And then you can see down here, there are places where you can stake your LP tokens. We'll get into what those are and how they work. So let's start simply by doing the farm APY staking. So here, you'll first need to connect your wallet, account F3 at the end, and I am account F3. You'll need to make sure those are lined up. And I have 0 farm. So if I click on max, nothing will happen. I need to go first and actually get some farm. And you can see here You can get them here, click get them here, and then I'll click I understand and click continue. Now, it automatically takes us to USDC to farm, but in this account we only have ETH. So let's start by just converting ETH into farm. I'm going to convert 0.05 ETH into 0.288 farm. So I'll have some farm tokens. You then click swap. Your MetaMask pops up. I'll make this fast for the purposes of this video. And my transaction has been submitted. All right, now that I have a balance of 0.28 farm, I'll go over here where I can see my farm. I'll then click stake. I'll make this fast for the purposes of this video. I'll start by approving my tokens. This obviously just allows the platform to leverage my farm tokens before I then actually can stake them. So we'll wait for confirmation here, and then I'll click the confirm button once MetaMask pops back up. All right, I'll now go ahead and stake those coins. I'll go to fast, and usually there's no rush, but for the purposes of this video, I want to go ahead and get through it and show you how it works. So let's talk about where the yields come from. Over here on the farm, you'll see that they have $500 million currently deposited that are auto-harvesting yields. So they're using the platforms of Curve, Compound, Sushi, Keep, and others in order to get the returns from these platforms and convert them into yields on the farms. So Curve has transaction fees from automated market makers. As you saw just now, when we performed this swap, we paid a 0.2% fee that went to liquidity providers who provide the liquidity, which we'll demonstrate and show how to do that momentarily to enter the next farm we're going to go into. But they're rewarded 0.2% off of every single trade. And Curve works in a similar way as an automated market maker, whereby fees are given to the people providing liquidity. In this case, some of those people providing liquidity are farm and its farmers who provide their liquidity into these platforms. Comp earns interest for allowing people to borrow coins, and Sushi is also similar to Uniswap and provides fees. So sometimes fees are generated from flash loan providers, in the case of Aave, in the form of fees that are converted for those loans into rewards. In other cases, for providing liquidity and being a market maker in the automated market maker system, you can get returns. And so they go across all these platforms that offer returns and then return those to the user. But also, Farm actually just mints a bunch of farm tokens for its users. So, for example, we are currently staking here, and you can see that my staked balance is already earning a return. You can see over here the amount that it's generating. So every so often there is an emissions drop, and what they do is drop out all of the rewards that are earned. This number that you're seeing over here is not the actual number that I'm earning, but how much I will be earning every single time cumulatively as they make these emission drops. So if you just stake, get a little bit, and then unstake, you probably won't get much return. You'll need to wait a little bit, usually a few days, to actually see the return, but it is building up at about this rate. So now I'm farming and I'm auto compounding, but let's do something a little more interesting. Let's join this farm, and I think this farm is a really good example of how liquidity mining works. I think it's a great example that everyone should try if they're looking to get into yield farming, to understand exactly what liquidity mining is. So I'll select this one. In order to participate, I'll need Uniswap LP tokens of Farm and USDC, meaning I'll need to go to Uniswap and I'll need to buy both Farm and USDC. So let's go ahead and do that. And now I'll have USDC and I will have farm. Now, what do I do with that? So you can see here it says you can acquire them here. I think that's why Farm is a good platform. A lot of platforms don't actually show you how and what to do to get the LP tokens, but in this case, I'm about to become an automated market maker. You can click on Add Liquidity from Uniswap info, and you'll need to provide some farm tokens and some USDC. So I'll provide 10 USDC, which at the current farm rate is about 0.097. So I'm going to put up farm and I'm going to put up USDC. I'll go ahead and approve these tokens so that Uniswap can leverage them. Okay, so one of those transactions just went through and the other one should go through in just a few moments. All right, now that they've both been approved, I'm ready to supply. Now what I'm doing here is usually done in much higher volumes. Usually you'll provide liquidity of at least 1,000 USDC and 1,000 farm because you're paying, $5, $10 in gas fees, and also because you want to get a real return. So when I provide this into the pool, I'm helping to support the price of farm against USDC because I'm providing liquidity. When people use Uniswap, all the trades are automatically quoted based on the bonding curve, and that bonding curve is based on how much of underlying tokens are pegged against the token that's being traded. And so I will add liquidity into this market. I am now helping it keep its price. The less liquidity that's in a platform or in a particular pair, the more the spread will be between the buy side and the sell side. So if you see a really big price impact of a potential trade with a small amount, or if you see a huge spread between the amount it costs to buy and the amount that you get when you sell, then that is indicative of a very low liquidity coin. Usually you'll want to trade the higher liquidity coins because you're probably trading in a coin that is liquid, meaning that it'll probably work out better for you if you're doing a lot of trading or if you need to get out of that trade at some point. So I will click supply and I will become a part of the community that is stabilizing the price of farm. Now once I get these LP tokens providing liquidity on Uniswap, I will now be earning a yield. I'm now just yield farming on Uniswap, and I can do this with any token pair. You can go and add liquidity to DAI or a new token the same exact way, and you will earn 0.2% of every trade, but that 0.2% is your percentage of the overall pool from what the user is paying. So even though the user is paying 0.2%, you're not getting that full amount, you're getting whatever your percentage is. So if I'm 1% of a pool and the fee that goes in is $100, then I'm going to get $1. So I'm adding liquidity now. This transaction should go through pretty soon, and in exchange for providing these, I will get the LP tokens. I can take these LP tokens at any time, and I can actually remove the liquidity, and in exchange for those LP tokens, they will give me back my collateral. Now, there is a thing called impermanent loss, in which case you may not get all of your USDC back or all of your farm back when you cash out plus your fees because of the trading activity that occurs on a particular pair. Now, when I refresh this page, I have 0.0000888. That's a very small amount, but that's about $10 of USDC and $10 worth of farm, which is about $20. I can now go and click on the max amount and click stake. First, of course, I need to approve my LP tokens to be used by Harvest.Finance. So I'll do that, and then another pop-up will show up, and this one is for me to actually stake my LP tokens, meaning that I'm not going to get the returns from the trades that occur on Uniswap between Harvest, farm tokens, and USDC, but they will reward me at a 225% variable APY their own token. So they're going to get these returns, which they can convert into what they send me. So I'm swapping my cash flow for 100% to 225% APY. So let's go ahead and try that out. So I've approved the tokens and now I'm staking them. And once you go through this process, I think it's pretty straightforward from here once you begin to use other platforms that do liquidity mining. Okay, now I've swapped my liquidity tokens and I'm earning a real-time yield. Let's refresh the page. So those are my staked LP tokens, and look, I'm already earning money. And this will just go up every once in a while, but I've already earned a little bit, and it's in the context of how I explained for the other farm of how the returns are currently working. So I'll go to farm, and so right now I have the profit share, farm, staking, and earning, and it's auto compounding. And then I have my Uniswap LP tokens, which are also earning as well. And I can unstake and claim my rewards, or I can claim my rewards, take my rewards that I have gotten, create new LP tokens using the process that we just laid out, and get that compounded APY that we want versus just the APR, which is what I'll get if I just let it sit here. Now these rates do change. They've gone, I've seen as high as 400 to 500% APY, and they've gone as low as 100% APY, but they could go higher or lower. I think the average is about 200% these days, and that may go up or down based on volumes and various dynamics associated with liquidity mining and these kinds of platforms. Okay, now that we've talked about LP tokens and general just staking, let's go to another platform that allows us to do this. One platform that's pretty popular is called Pickle. You can go to Pickle.Finance, and I'll go to the app. Now this platform was recently hacked, and in fact Harvest was hacked as well, using various things such as flash loan attacks as well as regular just race conditions within the smart contracts. It seems as though it's almost a thing that all major platforms that are in the yield farming space must go through. Some of them are inside jobs, and some of them are outsiders. A lot of these are anonymous projects, so you never really know, and so you should proceed with caution if you plan on using any of these platforms, as many of them are run by anonymous groups of people, and so you will have very little recourse in the event of a hack attack or other kind of bad event. So here you can see jars and farms, and you can see here there's a 92% APY. So that's pretty good. And if you want to diversify your yield farming strategy, you might want to earn 200% in one area and then go to another platform and earn a percentage here. Later in the video, we'll talk about how to cover some of those risks that might be associated with these various platforms and how to get in and out of your farmed position dynamically. So let's start here. I want to stake this, but first I need Pickle and ETH liquidity tokens. So we know how to do this. Let's first start out by getting some Pickle and then create our LP tokens on Uniswap, and then we can go in, approve those tokens, and stake them. So first, we'll need to go find the address. One of the best platforms to go and find addresses is just by going over to Etherscan, and here is the Pickle token, all right? So I'll go to the contract, and I'll copy the contract address, and then I'll go back over to Uniswap, and I'll convert 0.02 ETH into this token. This is Pickle. So I'm going to get 0.87 Pickle in exchange for my ETH. I'll click swap. So now I have Pickle. What I really want to do is add liquidity so that I can get the LP tokens. So I'll go back over here to add liquidity, and I'll put in the Pickle token, and I'll click over here and put ETH. They want ETH and Pickle. So I have 0.8 Pickle, and That's equivalent to 0.01 ETH. I'll then go and approve my pickle for Uniswap to use. So I have an approval, and now I'll click supply, click confirm supply. All right, now that's been confirmed, I can now go over here and I can put my max. I'll refresh the page. All right, and there's my balance. And I'll go ahead and click max. And usually what I actually like to do is whatever my balance is, I'll cut it off a bit of it so that I know when I look at my wallet that that amount is, some pickle is in there or some farm is in there, a really small amount, just so I can remember, oh yeah, I'm staking there, because by just looking at Etherscan, you won't be able to actually see sometimes your staked balance, and that can be, if you have a lot of accounts, it can be kind of hard to find out which account. So that's what I do, and I don't know if that'll be useful for you. So I'll click stake. Now first, of course, I have to approve the tokens for the platform, and one important area that you probably already know is that you only have to do this one time ever for each platform per address. And then once you've done that, you're able to just stake and unstake without having to do a bunch of stuff, right? And then it automatically pops up again, and then I'll click advanced, and I'll click confirm. All right, now I'm waiting for it to begin staking, but once it is staking, I'll be earning a 92% APY. Of course, this is variable, it changes, it can go all the way up to 200, go all the way down to 50. It could go lower or higher, depending on various dynamics associated with these platforms. And so now I have a diversified portfolio that it's not that diversified because there's only 2 platforms that I'm on, but you could go to many other yield farming platforms. Now, why I can only see my farm token and my pickle tokens actually have much higher balances because they're staked in other addresses. So you have to kind of keep track of that. One day, Etherscan might actually show you staked balances here, which would be really useful. But for now, if you're doing this today in 2020, you're not able to actually see that directly from Etherscan. But there are some really great platforms out there that allow you to connect your wallet and see all of that, including places like Zappify. So if you look over here on Zappify, I can actually see that I have 61% of my portfolio in deposits, and I can actually go and see that I have Harvest, and I can explore and see what I have on Pickle. So using a platform like Zappify can help you manage your portfolio a little better than you can probably do on Etherscan and get a more robust understanding of what's actually happening versus this, which would say I only have $7 worth of tokens. And of course, Zappify would need to support the platform, but usually major yield farms will be picked up by Zapper pretty quickly. And there are a few other platforms that are pretty good out there as well. Now, let's talk about strategy. So I'm going to go look at the price of Farm. So I go to Uniswap Farm USDC and look at the full chart. Now, here's the 5-minute chart, but let's look at the 1 day. All right, so it's a pretty volatile asset. Now, if you have farm coins, you are, let's say if you bought it here at approximately $103 and you're earning a almost 1 to 2% a day. You were making money, you're making money, and now you're earning a lot more because while you might have 100 farm tokens and you're earning maybe 1 farm per day, now you're still earning 1 farm a day, but as opposed to it being worth 100 something dollars, it's worth $285. So you're making a lot of money here. But then when the price crashes, and this was a hack actually, something happened, and the price went back down, this wouldn't have been so bad for you because you're still getting your yields at the price that you bought at, and it continued. But let's say you bought it here at $183, you're getting your yields, but now you're making much less. The goal for a lot of people is to enter yield farming platforms when the prices are low, and then earn yields on the way up or steady. The best place for it would just be to be completely steady, and if it just stayed that way, then you'd be making 1 to 2% every single day, which for $1 million, that would be $10,000 a day. And then when the price tripled, that would be $30,000 per day. Pretty good. But if you bought up here, you'd be making $10,000 per day, and then you're making much less. So the ideal situation for a yield farm is to get in low and or just in the average price range. Now, what some people do, and one strategy that we'll cover today in this video, is let's say you purchase and buy into a yield farm here at 102. And let's say the price goes all the way up, but it begins to drop. It drops all of a sudden 5 or 10%. Right here, this could be a signal that something very, very wrong has happened, which that's exactly what happened here. People had actually quite a few days to get out. So what you might want to do is, if there's a major price drop, you might want to exit from the farm, unstake, and get back your USDC completely, and then wait until things steady out a bit, and then purchase back in. In this way, you're not necessarily as much speculating on the price as much as you are focused on just getting your yields, because again, the best scenario is it just kind of stays even, and or the price just goes up. Either way, your annual yield's okay. And even then, if you bought in at $177 and the price goes down to $100 over the course of the year, you're not going to get from your initial principal the 200% APY, but you'll probably still make, if the APY stays in the 100 to 200% range, between 50% to 150% APY, which is pretty good. But the price can drop much further down here, and if it does drop really big, really fast, you'd want to get out. But even if it went down to, let's say, $1, it'd be okay if you're still getting that 100 to 300% APY. You just want to buy it when it's low and then get your yields. And when it's tanking, you want to sell it, go to safety, wait for the price to stabilize, and then re-enter. In a previous video, we talked about setting up alerts. So using your Pine editor, you can easily go in, and you can follow the previous tutorial on how to set up alerts, but you could tie your alert to look for a major drop and tie it to an endpoint that will point to a app that can then unfarm your tokens and then sell them. So let's take a look at some code that can do that. So this is a simple smart contract that has the Harvest interface. I've left a link in the description so you can check out this code. And it has the Pickle interface for entering or staking coins, as well as exiting the coins and then getting your balance of a particular staking token. So we also have safe math in here, and we have ERC20 interface so that we can interface with tokens, and then we have uniswap because we'll need to swap from the token like Farm back into USDC when things go wrong. And this is just a simple contract called Farm Enter and Exit. There's a notice at the top that this is meant only for educational purposes. This has not been audited. This is actually a simplified version of a much more complex contract that does quite a bit more and has a few more farms and a little bit more extreme logic. What this essentially does is it has a constructor that sets the owner, and only the owner can interface with any of these particular functions to keep you safe. And then it has a staking directory. So this is the farm token, and then this is the Pickle USDC token pair that we just were looking at, and it also then ties it to the actual contract that's used for staking. So each time we interfaced with MetaMask, that was always with a particular staking contract that was tied to a particular token. So we have our staking directory set up as a mapping. And if you're not familiar with Solidity or how any of this works, you might want to look at previous videos that we've published where we go into the basics of all of this. And then we have, most importantly, an enter farm and an exit farm call. So you say which farm. In this case, one would be Farm or Harvest.Finance, and two would be Pickle.finance. And the token address. There's many different tokens for each platform, but this example is mostly for the Farm token, the first one that we did. What it essentially does is it gets the token, it gets the balance of the message.sender, which is the owner of the contract, and it transfers from their account the total balance to this contract. Then it makes sure that all of those tokens are approved on the staking contract, which is defined in the directory. The directory can be updated up here, update staking contracts, and this is only for the owner, etc. So no one else can go in your contract and update all this. Additionally, in case USDC moves their token address or Uniswap moves their contract address, which has happened numerous times, you can update those as well so that you don't have to deploy a whole other contract, or a previous contract doesn't come defunct and have coins that just sit in it that you can't move. Then it calls the stake function, which is an internal function that then basically says if it's the farm one, it uses the Harvest.Finance interface and then calls the stake function of the amount, which is the total amount of farm that is there. Additionally, if it's which farm is two, it will, in this basic example, just add the interface and instantiate the Pickle platform and then call the deposit function. So they call it stake, they call it deposit, and then there's a function for unstake. So what this essentially does is if it's Harvest.Finance, it unstakes, and once it unstakes, in the case of just a regular token, like for example the farm token, it actually performs a uniswap whereby it converts your farm tokens into USDC coins and then transfers those back to you, the message.sender. So all of the tokens are actually held in your account the whole time. And over here, if it is a Pickle LP token, you would actually need to do quite a few more steps, which we've excluded from this example because it's a bit more complicated than what we're currently covering. But essentially, it will just unstake them and transfer them back to you after it performs the unstake up here. So what you'd want to do is set up a Node.js app that can interface with a smart contract like this that can call the exit farm or the enter farm upon the appropriate conditions. You could analyze this and you could look potentially at the relative strength index. So you might look at this to make a determination, and then you can of course create alerts or event listeners. They could call your Node.js app, which would then interface back with this smart contract that could both enter and exit the farm. Additionally, there's a few functions in here in case tokens get stuck or something to withdraw the tokens that are in there, kill the contract to relieve space on the Ethereum blockchain, as well as get your staked balance, etc. To understand this contract, if you need help, you probably can just refer to previous videos where we cover basic Solidity and DeFi programming. Now, let's look at the Node.js app. So here, if you're looking at the OR feed repository, you can go to the Node.js examples, and then we have the yield farming, entry and exit, and you can look at the index.js, which is the main contract. And basically, you can do a Command F and look for your, and everywhere there's your is where you need to put stuff that's yours. So for example, you'll need to put your inferior key in here, your private key for your wallet, as well as your public address and your contract address where you deployed the code that we just looked at to the Ethereum blockchain. There you'll have your ABI, etc. And you'll have the simple exit farm and entry farm functions. You'll also probably want to set a high gas price because it is of the utmost importance. What some people do is actually the ability to look at the pending transactions to see if a transaction that could lower the price is coming through, and then you'd want to get in faster than that transaction. Let's say it's a malicious attack, or if it's just a large whale who's trading, who's selling, putting sell pressure on, and it's going to kill the price, you'd want to set a really high gas fee that would be associated with beating that other transaction that would allow you to basically call your exit the farm much quicker, or if it was a big thing that was going to make the value of the token go up, you'd want to enter the farm earlier before the price went up. So that's why you'd want to automate this, because it'd be nearly impossible if you're just a human looking at a screen, though I do know some people do actually try to do that. So there's two major endpoints in enter farm and exit farm. Of course, only you should have the URL for this, but you can further protect it by adding authentication and API keys. But this is just as a simple example to get you started for interfacing with your smart contract. So you can enter the farm and it will call enter farm. Your contract is already initiated up here. It'll call the exit or enter farm strategy, whichever one you're looking to do. Use your public key, and your private key is already authenticating you at the top of the function right here. So that gets done for you. It then calls the function. The gas limit is set just really high so that you can get your transactions through. Of course, like I said, you'll want to set a pretty high gas price that can beat the other transaction if you're pulling data from the pending transaction pool. If you're pulling your calls from something like this, like alerts, then you can just set a really high gas fee for many of the gas trackers that are out there and just use the fast parameter there. So you can look at that code. That example is on GitHub inside of the Orfeed repository. Also, if you've been wondering about the newer versions of Orfeed that have been pending for quite a while, we've been examining a lot of the changes that have been happening across the DeFi space and trying to incorporate those into what's happening. Things move really fast, and we want to ensure that some of the coolest stuff is all considered for the next version of Orfeed. But in the meantime, we have a few little treats like this that can maybe be of use. So you can get that. You'll of course need to pull out this folder and deploy it, but you can see how to do that in previous videos. And if you've been following along, this should be pretty straightforward for you. So that's a way to maximize your yields and ensure that maybe you can, if you're putting large amounts of money, you'll definitely want to have like a Node app that interfaces with a smart contract that can manage your position for you. And you'll definitely want to diversify. So diversification is key. Additionally, watching the uniswap market as well as potentially pending transactions can be a very useful tool for making your strategy most efficient for optimizing yields. I hope this video was useful. Thanks for watching.